Hey, good. Well, I was about to say good morning, everyone, because today is Teaching Tuesday. But listen, we just changed time, so now we're doing Teaching Tuesday at 7 o'clock p.m. Sorry, I'm in the room with automatic lights and all that stuff. Ben, but look, I have on my insurance agent shirt because instead of a foodie, instead of the gym guy, today, Ben, I'm the insurance agent and I'll be there for you. How nice is that?
So did we get sponsored by somebody? I didn't know it. We got music now. You got a shirt. You got lights dimming on their own. What's going on?
Look, we've been upgraded, Ben.
Wow.
I'm now considered Jopra of the insurance podcast industry. So yes, the studio has changed and the time has changed. So everyone, we want to welcome you to Teaching
Wow.
Tuesday. It is 7 o'clock p.m. and today we're going to talk about all things insurance, where we discuss health insurance, life insurance, Medicare, and retirement planning. And as always, guys, I have my friend, my brother, and one of the top insurance advisors in the country with me today, Mr. Ben Simpson. Ben, say hi to everybody.
What's up, guys?
So listen, y'all, we missed last week. Ben was doing some traveling. I was doing some traveling. So thank you all for coming back and seeing us today. Today, guys, we got something we're going to talk to y'all about. It's important. But before we get started, there's two things we need you to do, Ben. You remember those two things, right?
I think like us for sure.
Okay, they got to like us. So like
What's
our
the other thing?
videos, share.
Oh, that's right. That's important.
Yeah, remember everything we give is breaking news, so we got to get it out to the masses, and the best way to do that is through sharing our content. So like and share our videos. But hey, Ben, today is Teaching Tuesday, so without further ado, can you announce what we're going to be talking about today?
Well, John, I got an email from you. It said the 5 types of life insurance, and I could only really count 3.
Okay, listen,
So,
maybe, just maybe, I sent that message at 3 in the morning after seeing like 10 clients that day, and I was just kind of all over the place. But there's a lot of different types of insurance, though, right, Ben?
a ton. There's actually 3 types that I could count, but there's a lot of subcategories that we can get into,
Okay.
John, and kind of explain some things and help the people out.
Okay, cool. So that's what we're gonna do today, guys. So thank you for joining us again today. It is Teaching Tuesday, every Tuesday, 7 o'clock p.m. We're gonna talk to you guys about all things insurance. And today we're gonna talk to you all about I mean, the three different types, the three different main types of life insurance. So before we get into this, Ben, I was reading the articles from Forbes. I was reading an article from Forbes about 3 days ago that was saying that the table talk in people's houses have changed. Like at first, people refused to talk about insurance, right? We refused to talk about death. We refused to talk about financial planning and all that stuff. But with the rise of COVID cases, of course, and some of the other things going on in the country, or around the world, people are expressing themselves more about their financial situation. Like if I were to pass, how my wife and my children are going to be taken care of. But one of the challenges that we have been is there are so many types of life insurance that it could be overwhelming. So what was interesting is it said the four main topics, or actually five. Now I can use the number five. The five main topics that are being discussed at dinner amongst households now are wills and inheritance, right? Like we talked about that, guys, asset protection. Um, 32% of the people are now talking about current health issues and concerns, going to the doctor, getting our breast exams, getting COVID tests, making sure pretty much we're doing
Colonoscopies.
okay.
Yeah.
Yeah. And then life insurance was at 30%, which is what we do, Ben. And then current financial status and our emergency fund is number five. So I wanted to kind of talk about this because now that people are talking about life insurance, kind of point them in the right direction of where they should go the rates, how they're determined, who the product is good for, who the product isn't necessarily for. So that's why I emailed you at
Well,
2 in the morning about
yeah,
it.
mortality has definitely been top of mind, right? I
Yeah,
mean, it's it's not something we want to think about, but hopefully we can answer some questions
yeah,
because every person's situation is different, and this will maybe help you who's out there listening tonight. Uh, there
man,
goes your
what am
light.
I going to do about this thing?
We'll help them determine what type is going to be best for their family, right?
Definitely, definitely. So, Ben, let's just talk about the three. I said there's five. You said there's three. So,
Well, let's have a discussion about that. Maybe you're thinking of something I'm not. So basically, I'm thinking about term insurance,
mhm.
whole life, which is a
Okay.
permanent form of protection,
Okay.
and universal life. But we can spin off to, gosh, several different ways from term. When we got return of premium, we've got living benefits, we've got convertible term,
Yeah.
and I don't know if you want to talk about how term works. Um, and really educate people on when that would be a need.
Well, let's talk about the main three that you named. Like you named term, whole life, and universal life, which I agree those are the main three, and that's probably the main three that people hear about too. So
Right.
let's just dive deep into those. I do want to let you know, guys, those that are watching, thank you so much for joining us. This is a fully interactive platform, guys. So if you have questions, if you have comments, if you like what we're talking about, if you don't, thumbs up us, chat us. We're here and we're gonna talk to y'all about it. So listen, y'all see that light keep going off. That's not my fault. I paid my bill, but it's on a timer. So if I don't move enough,
You got to
uh,
start doing jumping jacks.
yeah,
It's true.
it's saving energy, right? So if I get up and do some jumping jacks, that's the reason why. But Ben, listen, let's jump into it. So tell us about term insurance. That's probably like the one that we hear about as insurance agents more often than not. So
Well, term is going to be your least expensive option, which is why it's so, I guess, one of the top options out there.
yeah.
But with term insurance, it's going to have an expiration date. So think of like renting something or leasing something. It's going to go, 5 years, 10 years, and you don't own anything at the end of it,
Right.
potentially. Now, term insurance can be used for mortgage protection and income replacement for an untimely death for someone that's younger is where I
Mhm.
like to see this. But there's also some subcategories that are becoming a lot more interesting than just your average term policy with return of premium. So people are like, well, gosh, with term, I'm out the entire amount of money that I put into it
Mhm.
over 20 or 30 years. But with return of premium, there's companies out there that will give you 100% of your money back, really forcing you to save while you're protecting your income when your children are younger. And I
Wow.
think that's a really cool benefit.
Yeah, that's a game changer, definitely. So guys, when we talk about term insurance, when we say term, we mean time limit, like the amount of years that the policy's active. So Ben, I know they start off where we have 5 years, 10 years, 15 years, 25 years, 30 years. So when we look at term insurance, guys, ideally we're looking at getting an insurance amount or getting a policy to cover a certain amount of time. And during that time, how is that time determined, Ben? Just to kind of clarify for the people.
From the term, so basically, we look at a couple things. We look at debt, we look at income, we look at mortgage, and we look at education when it comes to term insurance. And
Okay.
the longevity of the term policy is really determined by if you have small children at
Okay.
home and how long we need to replace income. Okay, so if I have, let's just say, a 5-year-old,
We
I'm
have
going to,
Alicia.
I'm
Remember
sorry.
last week, Alicia?
Alicia. Oh yeah. So Alicia, let's take Alicia, who was a 1-year-old. I want to
Yeah.
make sure Alicia gets through college. So I'm going to look at least, at a 25 or 30-year term to replace my income. Now it could be a mortgage that you're trying to pay off, and those are also 30 years typically. unless you paid down a few years and now you're just getting started. Could be a 20-year. But that's really how we're going to determine the length is based on how long we need to replace income or a mortgage protection type situation.
Okay,
Oh, sorry. I saw Sabu was asking about whole life. I'm going to get to whole life here pretty quick.
Yeah, Sabu, we're going to get to whole life. But when it comes to, thanks for that question too, Sabu. So when we think about term insurance, and Alicia was one, and I want to be able to replace my income or the income that I would use to take care of her if something were to happen to me, right? So I would maybe do a 30-year or 25-year term to get Alicia out on her own and stable. And then at that point, once that liability goes away, I will be able to that term would cancel and I'll be able to get another policy, right? Okay.
Yeah, you've got some convertibility options too, John. So into a permanent type policy, depending on the product. But that's not on every policy. So just be aware that you take a look. So not all are convertible.
Okay. Now you did mention something, Ben, that's very, very important. And I think it's something, guys, that we all need to pay attention to. Ben mentioned the return of premium on these term policies. So for a long time, term policies, like you were saying, Ben, were just policies that you paid into it like you were leasing a car, right? Like I'm paying into it every month, every year, and then once it's over, it's done. My money is gone. My money's gone. My money's gone, but ultimately, the insurance is over. But now that we have the return of premium policy, I'm able to get some of my money back that I've paid in over 20, 25 years. And at that point, it can be used as like a savings tool in a way, right?
Correct. Yeah, it's just a forced savings. And at least you get something back at the end of the day, which is nice. The other thing nice with the new type of policies is you don't necessarily have to die. So there are things called living benefits as well, John. So if you have the old type of term insurance that really doesn't do anything other than, if you die, it's going to pay a benefit, which is a good thing. It's going to do that. But there are new policies out there that if you had a heart attack, cancer, stroke, you become blind, it's going to pay a benefit ahead of time. And that's the other type of life insurance that people don't know that may be embedded in their policies, and that's not discussed. So with us, that's something that we like to bring to light as well, is you don't necessarily have to die to get a benefit. So
yeah, and definitely, guys, this is a perfect example of getting your policy reviews every year or every couple of years. If you have a policy that you've had for the last 5 or 10 years, this is crazy. As you have for the last 5 or 10 years, give us a call or call your agent and do a policy review. And that way we can go over all the new benefits that's available with your term policy. Okay.
Exactly.
So Ben, that covers term, but what was your second one? And I know Sabu asked the question.
So right. So does anybody have any questions about term before we move on?
Anybody? I have one. All right, Miss Deborah asked, what are the requirements to get a term and how much can I get?
So there are simplified issue policies out there right now that have John, between 5 and 10 health questions, no medical exam. You don't have someone coming out and doing your height and weight. There still are qualifying questions that obviously we're going to ask to see what's going to be the right fit. But we've been doing it long enough that we're going to get you in the very best priced product for what you're eligible for, essentially.
Yeah, and definitely, guys, remember what Ben and I do, we're brokers, right? So we have maybe 75 insurance companies that we work with. So when we speak to you all, let us know what medicines you take, what health conditions you have, when is the last time you went to the doctor. and then let us place you in the right area or situation that's going to be beneficial for you financially, as well as getting you the coverage options that you need. So that's a good question, Ms. Deborah. Term policies, Ben, how much of a policy limits are we looking at with term? I know I've done some huge ones, but tell us what's your thoughts on that?
Um, John, we can go, 50,000 all the way up to, 50 million. We have companies that will do that depending, you have to qualify financially for a $50 million contract. But yeah, those are available, and very big death benefits.
Okay.
John here in a couple of years, he may need a $50 million, Jopra death benefit here. So I may need a key employee contract on John. I don't know.
There you go, y'all. So when we look at life insurance, we're looking at usually like your expected income loss or your current value, home ownership, savings, income, all that stuff. So good question, Miss Deborah. Ben, whole life.
Let's talk about whole life. So really, when we talk about whole life, that is a true permanent product. Okay. So what whole life is it's definitely going to be there when you die, as long as you make your premium payments. And essentially, that policy premium is going to stay the same for the entire life of the contract. It is the most expensive form of life insurance. And there are two different types of policies when it comes to whole life. Participating, which basically based on the profits of the insurance company will pay a dividend. Now, those are really kind of going by the wayside. I don't see as many contracts like that I review as much, but that can be a good way for retirement income planning if you have a situation like that where you need more of a guarantee. And then you've got non-participating, and that's basically going to pay a death benefit. But just remember, and there's no dividend, obviously, on non-participating. So you can pull out your contract if you have a whole life, and John needs to do some jumping jacks again. It's always a surprise. He's got a baby, the last one, and now his lights are going off. It's crazy.
So Ben, look, don't take us too deep too fast, because you said a lot, okay? So of course, me being Jopra, I'm gonna break it all the way down. Y'all. So listen, a whole life policy is exactly as it sounds. It lasts your whole life. Okay. Remember, we talked about term and we said that lasted for what, 5, 10, 15, 20, 30 years. Well, a whole life policy does not have those same it doesn't have those same time limits. It's actually no time limit. If you get it at the age of 20, it's going to last your whole life. If you get it at the age of 5, it's going to last your whole life, as long as you continue to make the payments. And listen, that's a big one, guys. You have to continue to make the monthly premium payments. And as long as you do that, the coverage stays in place. Okay. So
John didn't pay his light bill is what happened.
Really. I'm gonna have to get up. Once I ask you this question, Ben, I'm getting up and I'm gonna go over to the side. So listen, Ben, explain that non-participating, participating thing again, okay? I'm gonna go deal with this light, but talk to the people.
Yeah, so it's simple. Really, a participating whole life insurance policy, based on the profits of the insurance company, is going to pay a dividend annually. Okay, so it's really, and I lost Jopra.
I'm here.
Okay, I see his shadow. He's still here.
Yeah, I'm here.
So basically, non-participating is a non-dividend paying policy. It's just going to be there for death benefit and cash value. So we do have several people on this evening, and thank you for joining us. If you can throw a thumbs up, or if you have some comments about our show or questions regarding term or whole life that we've covered, please go ahead and put that in the comment box, and we can answer some questions.
Yeah, let's see. So we got some questions, Ben, about whole life that we had already received. So this person asked, what about the cost for whole life? How is it compared to term?
It is the most expensive form, and again, that's just because the insurance company is guaranteeing that policy. So so you're going to have your contract, whatever it says for cash value or death benefit or premium, everything in there, unlike a universal life policy, is going to be exactly what it says. So there's no deviation. The contract is the contract with a whole life, and essentially, you're paying for that guarantee of the policy to be there the entire life, and the cash value buildup with the whole life, which I failed to mention earlier. They do build cash value. You're going to want to, it is guaranteed. So, and that's why it's a little more expensive.
Okay. And I know like the cash value subject is a subject that I keep hearing a lot about. And I speak to some of my clients and I ask them, they say, I want that policy that builds cash value. And Ben, we're going to do, I've already did.
Yeah.
Where's my cash value? Maybe we'll do it next week, but a lot of people talk about the cash value, but listen, guys, when we're getting into whole life policies and cash value, you have to pay for it, right? Like it's not the $30 a month policy.
Yeah, exactly. Exactly. So if you're being sold, and I'm going to get into universal life real quick, I guess. Is there any other questions? John, do you see any other questions on whole life? Because you're getting me going. I'm getting fired up about universal life. I really am.
No. Look, Ben, don't rush my show.
I'm sorry. I'm getting fired up. You get me fired up.
Let's see. I had another question about whole life. Whole life. It says final expense insurance. Is that considered whole life?
Yes, and that's going to be a non-participating form, meaning it's going to build a little cash value. The premiums are not going to go up. Okay. It's going to be guaranteed the rest of your life, and it's going to be there, when you die. And I do like to see that as people age, just to cover burial. Okay. And it is a good form of life insurance. And quite honestly, will take people with very severe medical conditions. Very liberal underwriting, because obviously people are buying in these policies, 60s, 70s, probably have some pre-existing conditions. The insurance companies know that and price them as such.
Okay. So to dive a little deeper into that final expense, being because I'm at the age, and we're at the age now where a lot of our parents are getting to their retirement age, right? And now that they're retiring, they're losing their life insurance from their employer. So now it's kind of hard for them to be 65 and get a 30-year term, or some of them that have health conditions that just simply can't qualify because of COPD or heart attack or stroke, some of the other issues that we deal with the term policies. So we usually resort to those final expense policies to at least give them something to cover burial expenses. Now, those policies, like Ben was saying, guys, they are more expensive. And the reason that I want to put emphasis on this is because, hey, Miss Mary, thank you for coming in. Sorry, I had to call out Miss Mary Ben. But the reason I want to put emphasis on this, guys, is because I had a client about a year or two ago, and I put her on a final expense policy, Ben. And it was a good policy. I mean, considering her situation. Well, she had gotten a phone call, and the policy was super duper cheap. It was like $9. You see, so guys, we have to be very, very careful about getting those type of policies that we see on TV, where they're like, "There's no health questions, everyone qualifies." Because once I sat down with her and we looked at that policy, for one, it was way overpriced for what they were giving her.
Hey, John, I want to say one thing because you're getting me fired up again.
Okay, I see you.
That's $9,000 or $9 per thousand.
What?
So
Explain
nine.
that.
So if you have $10,000 of coverage, that's going to be $90 a month.
So they're advertising 9.99, but that's only for $1,000 worth of coverage.
Exactly. Exactly.
Yeah. And another thing being some of those policies I've seen, they last for like 20 years or 15 years, and then the premium starts to go up every year.
Exactly. Or they end at age 80.
Okay. Okay. So
And that's awful.
that's a good one, Ben, because and maybe I shouldn't go this far, but if they're ending at age 80, is that a true whole life policy?
No, but they're being sold as such. So that is fake news, John.
Uh-oh. Fake news. So listen, y'all heard Ben say it. I didn't say it. Some of
Sorry.
these commercials that we're calling into getting insurance over the phone may not be giving you all the small details. Listen, if your parent, if yourself, if your brother and sister have went and purchased a policy because they saw different people on the TV, call me, call Ben, and let's do a policy review, because that way we can kind of point out some issues with that policy and get you all in the right type of situation.
Well, and
Okay.
if they made a good choice, John, can't we tell them that they did a great job?
Absolutely. And then we can help them. We can
Exactly.
bring them on and let them work with us.
Yep. Pat them on the back and tell them a good job. So no, no harm, no foul.
Right, right. So listen, y'all, if y'all got those policies, those whole life policies, you're paying $1,000, you're paying $9 for $1,000 worth of coverage. Call us, we can talk about that, or send us a message now and we can kind of get you scheduled. But Ben, I see you over there all hyped up.
I'm getting fired up.
But it's probably because you're drinking that like Red Bull or something.
Yeah, I don't know what this is, but it's delicious. Can you see that?
Let me see.
It's a cranberry grape. I don't know. It's good.
Brandon, I mean, all right, Ben, I can't market a different type of drink without getting our.
Oh, I didn't show it. I didn't. Oh, did I show the logo? I'm sorry.
Yeah, yeah. Like now, all of our million followers are gonna go buy that drink, and
Well, maybe they'll sponsor us.
So listen, so Ben, you're hype about Universal Life.
Universal Life. I've got a question for you, John. Is it permanent?
Universal Life can be permanent. It's a mix of the two, right? So we're looking at a mix of permanent insurance as well as a term or amount of time that. So I'm thinking that there's a mix of the two, and you can kind of customize it to fit your personal needs, whether that be savings, retirement, college education, all that stuff. So Ben, you're the expert though. I mean, I'm kind of an expert.
I think you're a better interviewer, John. That's I answer the questions.
There you go. Answer this question, Ben. What is a universal life policy then?
Universal Life. Has anybody out there listened to Dave Ramsey? Anybody? Anybody? Nobody?
Thumbs up. Thumbs up if you listen.
Thumbs up if you've listened to Dave Ramsey. And there he goes again, going dark.
Thumbs up if you listen to Dave Ramsey.
So Dave Ramsey, I agree with 95% of what he says. And he says, buy term and invest the difference. I disagree wholeheartedly.
Why is that?
Okay. Why is that? Well, you know what? Buy term and invest the difference is? It's called Universal Life.
Okay.
Okay. So with Universal Life, we have a life insurance component. And if you don't fund it, if you want to fund a Universal Life or an Index Universal Life with $30 or $50 or $60 a month, and you're, say, 40 years old, you know what's going to happen?
What? What's going to happen?
It's going to end. It's going to be a term. It's no longer permanent insurance.
Okay.
Because with Universal Life, you have life insurance and you have a savings account. Okay. So you have to fund both of those.
Okay.
And if you're not funding the savings account and you're only funding the life insurance or vice versa, then guess what? You're not going to have life insurance or a savings account.
Okay.
That's why Dave, I'm sorry. Go ahead, John.
So let me tell you the issue that some people have with Dave Ramsey is saying buy term and invest the rest, right? But in that case, we buy term and then I buy Starbucks, right?
Yes.
Or
Yes.
I
Yes.
buy term and then I go buy a new insurance shirt,
Yeah.
right?
A
So,
TV.
right. So when we look at the whole idea of buying term and investing the rest, many times that's a problem because we don't invest the rest. So in this case, with a universal life, what would be a better way of making that happen? Being
Well, so with Universal Life, we have an internal interest rate. Okay. Right now, they're very low, but they are going to go up. I mean, interest rates, the Fed at the end of the month is going to raise interest rates. And I believe they're going to raise interest rates maybe 3 or 4 times throughout the year. And the nice thing about life insurance, especially Universal Life, is their interest rate bearing type policies. So as interest rates rise, it is a very good place to have your money. So if anybody was alive and owned life insurance back in the 70s or 80s when interest rates were double digits, those were great places to have your money. But what happened was over the next, 20, the last 20 years, interest rates have been 1, 2%, 2.5%. And if you've had those policies, which were woefully underfunded because no one looked at them again, those policies are eating away at the money that was saved. And now the cost of insurance is eating those policies or eroding them away. And you're going to get a phone call if you haven't done a review of your universal life policy. And the insurance company is going to say, hey, we need an extra $300 or $400 a month to keep the policy active.
Mhm.
Okay. So, Universal Life is a great product if you are having annual reviews or every couple year reviews with your customers, which we do.
Okay.
Um,
So
so, yeah. So, go
that's
ahead.
a good point, Ben. So because I've had, again, guys, when we're looking at, we're looking at term, whole life, and then universal life. These policies, when we're looking at a universal life policy, is not your $30 a month policy, right? Because pretty much you're not funding it enough for it to create value. Okay. So tell me, Ben, financially, what would the person look like that would probably get a universal life policy? Like, can you
Well,
give some ideas?
yeah. So, there's a couple different products. Okay. And this is where we get into subcategories again. There's a guaranteed universal life that's going to be more like a lifetime term. Okay. It's not whole life where it's building a cash value. It's actually basically a term to age 90, 100, 105, 120 years old. You can kind of dial in the death benefit. It's going to be guaranteed for the rest of the contract or the owner's life, essentially, just like whole life, but without the cash value. And that's very good if someone's looking for, they're passing money on to some heirs. They're 65 and they are essentially took out a 30-year mortgage and don't want to leave their spouse with a mortgage payment. They're
Okay.
very good for that. And then you've got index universal life, John.
Okay.
And index universal life we are using to create tax-free retirement. And tax-free retirement is awesome if it is funded correctly. Like John said earlier, you cannot basically fund an index universal life with 30 or 40 or $50 a month and expect it to be 50,000 in guaranteed income down the road. It's just not going to happen.
Okay.
The math's not there, and neither is the interest rate or the cash accumulation account.
Okay.
So, an index universal life is really taking like the S&P 500, the Dow Jones, the Russell 2000. They're taking an indice and essentially taking the fixed account money. So if it's 2.5%, and that's what they're investing, so they don't lose your money. That's what the insurance company believes. They're happy to risk. their fixed account to help gain them money and gain you money without any downside risk to your cash account.
Okay, good deal.
So,
So and we've looked at the illustrations, guys, and when we're looking at universal life policies, it's a little bit more complicated because it's going to be an illustration attached, right? And that illustration is going to kind of show you where your money will be in 10 years, where it will be in 20 years, where it'll be in 50 years. So Ben, there's no potential of losing money, right? It's just the ability to gain when we're looking at
correct. So I like to tell my clients, especially looking for tax-free retirement, that zero is your hero. There's no reset if we have a downturn in the market. So it's basically it's going to be flat, and that's really nice to have. And then the other thing is, as interest rates rise, you really have the best of both worlds. You've got money that can gain double digits in the market, okay, with no downside risk. And then you've got something with life and annuities, the only two places I know that will do this, where we've got a fixed interest account that's going to be rising over the next 10 years due to inflation. So as interest rates go up, we're going to have a very nice fixed interest rate that we can kind of split money between and have the best of both worlds.
So, guys, and if I know Ben and we're trying to speak as simple as possible, but universal IUL, index universal life policies, aren't easy to explain, right? So remember, y'all, we have the ability, and you all have the same ability to ask us questions right now, to send us messages right now. If there's something that you want to know and understand more about, just send us a question to the chat and we can try to get to it. Y'all see Ben likes to talk. So Ben would love to hear y'all questions. He would love to hear y'all.
And I'm trying to figure out in this platform, John, I'd love to show people an illustration, because what John and I do is show people in writing. We're going to show you a 40-year-old putting $50 a month into an indexed universal life policy, what that looks like in 20 years.
It's
and
amazing.
It's probably, well, it's not amazing. You'll be amazed because the person that sold you the policy was just trying to make a commission. It's not really doing anything other than that for the agent. And, it's not really helping you unless your intent was to have a policy that ends at a certain time with very little, if no, savings. For a child, that may look okay, but not when you're my age or John's age.
Right. So Ben, I know we're on this new platform. Do you have an illustration on your screen that you can show?
I wish. I don't. You're going to have to show me how to do that, but I'd like to get on here and talk about index universal life and the myths that are out there right now, because we both have run across that a lot. There are a lot of people that are just trying to peddle a product instead of doing what's right for you, our audience.
Right. So we've covered the main three. Of course, I have my notes. So we have term. So Ben, just to kind of break it down, simple, quick questions, just to give everybody that's just came in. And y'all, thank you for joining us. We got a lot of views. Ben, term insurance, who is it perfect for?
Younger people that own homes, people trying to replace their income if they have an untimely death and want to take care of their families.
Okay. What about price? From more expensive,
cheapest form of life insurance, because typically it has an expiration date. Okay.
So let's advance to the next. The next one was whole life. Ben, who is whole life perfect for?
Somebody that's got a budget, because it's expensive, and it's someone that's looking for guarantees. They are very conservative. They can see exactly what is going to happen at the end of the rainbow.
Okay.
from a cash value standpoint and a death benefit standpoint.
Okay. Okay. Good deal. So when we look at less expensive to more expensive, where does it fall in that category?
Oh, most expensive for whole life.
Most expensive for whole life. So now we're at IULs, and we know this is complicated. But IUL, who is the target person that will get an IUL policy?
Someone looking for tax-free retirement income down the road.
Okay, so let me ask you with this one, because and Ben, you know, you and I can sit here and talk about we can talk about the IULs for a long time. And I guess I'll save that question for later. I got another question from Miss Deborah. Um, Thank you for joining us, Miss Deborah. We're going to talk about universal life later because she was asking about pulling cash value on a monthly or yearly basis, but that's something that is kind of
I'd
far-fetched.
like to cover that one-on-one with Deborah. I think
Okay.
that's everybody's situation's different, and I would have to do a full analysis of her financial situation before
Okay.
I could give her any feedback.
Okay. So out of all three of those policies, so we have whole life, term, and IUL, which one are more customizable based on your
The
personal?
most flexible type of insurance, life insurance, is universal life.
Okay.
But with that flexibility becomes failure. If you don't, if you decide, hey, I'm just going to stop funding this for a couple years, universal life takes some discipline for the cash accumulation type accounts. You have to be on board with the program 100% if you're going to make that decision.
Okay. Okay. Good deal. So, guys, we've covered a lot. We've been on here for about 40 something minutes, and y'all, Ben will sit here and keep talking and talk. We'll be here at 9 o'clock. We'll be here at nine
Sure.
o'clock talking to Ben about universal life insurance.
I love
So,
it.
yeah, yeah, yeah. So this is good. We covered a lot, guys. We've covered the three type of insurances. Okay. And to those people who are trying to save on your electricity, you definitely need to get one of these timer lights because your light bill is going to be super low because it's going to cut off like every 5 minutes or so. But we have covered a lot, guys. If you all have questions about anything that we've talked about, you can feel free to reach out to us on all of our platforms. We have Facebook, LinkedIn, IG for both me and Ben, or Ben and I. Of course, once this video is posted, we're going to leave the information below. Keep in mind, guys, you also can register on our link. That way you can get all the updates, all the new information, all the updated or incoming, not incoming being the future, all of our future Teaching Tuesday moments too. So Ben, is there anything else you got to say before we get off here?
Nope. Just want to thank everybody for tuning in again, and shoot us your questions and tell us a little bit more about your situation. We'll help you design the best program for you and your family.
Definitely. And one thing that we learned that we didn't learn anything else today, guys, and that was to get your policy reviews. Okay. It's no obligation. We'll look over your policy, help you better understand it, and see if there's something better for you or if we need to give you a pat on the back because you did the right thing.
Absolutely.
So, as always, guys, I am an insurance agent. I'll be there for you. But in the meantime, I'm about to go eat. Y'all know that's my thing. Ben, you go take care of the kids, and we will talk to you all next Tuesday at 7 o'clock p.m. Be here or be, what is it? Be here or be
Square,
I don't like that.
circular. I don't
Yeah.
know. I don't
Be
say
here or
that.
be square. We'll see y'all later. Thank you for tuning in. Y'all have a good night.
Good evening.